Mind if we
I
record
started
this?
the recording.
Flood's changing a lot. So this is actually good that we're getting together. We've done some e-blasts and things, and I know we've had some emails, but it's good to actually talk about it, go through things. And then when it comes to the meeting, with the other folks, I'm happy to, as I've said,
Yeah.
I'm happy to call in or come here in person and
Yeah.
just talk about it,
Okay.
because it's painful.
So Jeff, we got all the slides. I got them here. I can bring them up as you want to talk to them.
Sure.
And we did, I sent you some questions,
Yep.
which
We can walk through those.
I think I looked at what you sent us, and I believe you're going to probably cover everything in your
Yeah.
discussion, but I'll even start right here so you can,
Perfect.
and maybe you want to go through these first,
I think that's a good place
Yeah.
to start. as
and
well.
just, we'll get that out of the way, and then we can go through in whatever order you want to go.
Perfect. Yeah, and so these questions, and folks, I'm sure you listening, you saw the email or you've seen this as well. There's 11 questions here, so I'll kind of walk through them. The ones that I've got documents on, I'll just mention and we'll dig into those. But I commend you guys for, first of all, kind of taking what I'll call a proactive approach, because it's not just Reflection Key that's going through this. It's really every association in Florida that's in any sort of flood zone. Or if you're in an A zone, it's not a state requirement to carry the flood insurance, but for lenders, that's where the requirement is. So there are very, very few associations in the state of Florida who are electing to go without flood insurance who are in a flood zone. I work with one particular association in Everglades City. So they are frame construction on the water. They've got
In the swamp.
in the swamp. They've got 24 unit owners. They vote on it every year to forego it. They all own their units outright. Trouble would be if one of them were to want to go sell their units. Obviously, no lender is gonna give a loan there. When you have common property, common elements, the building is what we're insuring here, not the individual units. The individual units would be on the unit owner for their own flood policy. So just like any association, you each own 1/174th of every piece of common element. So that's where it comes from. All right, so let's dig into the question. Sorry, that was just kind of a tangent. So question one, historical.
Before you start, Mike, is there a way to move the computer a little closer to Jeff so we can, I'm just having a little bit of trouble hearing here.
Yeah, just a minute.
How's that, folks? A little bit better?
Yeah,
That's-
that's better.
Let me, okay,
So the first question has to do with historical flooding. When's the last time this property is actually flooded to a level that has caused damage to our buildings? To my knowledge, you all have never had a flood claim. Flood is very different than, pipe bursting. Flood, we're talking about rising water from rains, storm surge, things of that nature, where it's actually pooling and coming up. So to my knowledge, you've never had a flood claim. Maybe years and years ago, but frankly, it's doubtful. So I don't think there's ever been a flood claim.
That would be pre-construction, we're basically talking about. This is 2008, so I think, has it ever, even before that, been flooded?
To
We don't
that,
know.
the land before it was developed, it's Florida. I'm sure it was about 6 inches above sea level before they put, 3, 4, 5 feet of dirt here.
Okay,
There's no record of us to be able to figure that.
okay.
Um,
But there's been no flooding since the buildings have been built.
That, to my understanding, yeah.
Okay.
how about in the surrounding area, like when Irma came through, yes, we didn't flood, it came up to the back berm,
Mhm.
but like any associations in the area that had any significant flooding?
So let me think. None that I work with. So not to think of the client list, but I work with the Reflection Lakes, which are a very
Yeah.
similar area. They're nearby. I think they were fine. Their streets were flooded, sewers backed up and things like that, but no water actually entered buildings. So no. Here's the reality, just talking about flood insurance in general. Florida is not even in the top 10 in floods for states throughout the country. Texas is almost always number 1, Louisiana's 2, and then Mississippi's up there. The reality is Florida makes up 34% of all policyholders for the National Flood Insurance Program. So they truly, and we have the highest rates in the country. So truly, Florida funds this National Flood Insurance Program, even though it loses money every year and it's subsidized by the federal government. We'll talk about flood risk rating 2.0. Maybe I'll touch on it now, But as of April 1st, the National Flood Insurance Program is changing their rating system. They're switching to a whole new rating system called Flood Risk Rating 2.0. And the idea of that is essentially to make the flood insurance program in the black, if you will, to make it more of a break even rather than it losing, billions of dollars every year. And they're doing that by basically, depending on your building value is the big factor. Wherever you have a higher building value, you're going to pay more in insurance. The flood insurance rate maps are still going to be a deterrent, but the elevation certificate, it's not going away, but it's almost optional at this point. So we always submit it because what we have found, we've only been able to rate like this since the beginning of September. What we found is when we submit the elevation certificate, it helps rather than hurts. So we're still doing all that, but the ratings have gone out of whack. I'll show you, I've got an example here, we'll get to that, of what, if you were just entering the
just
flood
went
insurance
out, right?
program today,
I think it was a realtor.
so if you were just entering a flood insurance program today, you'd be subject to the true rate, the brand new rate, which is, as we'll talk in a minute, it's 3 or 4 times what you're actually paying now. Why that's important is it gives us the glide path for where things are headed in the next 3, 4, 5 years. So it's capped at what your annual increase can be, right? So it's capped at 18%. But what we're anticipating, and National Flood doesn't actually tell you this, but what we're anticipating is more than likely it's going to be an 18% increase each of the next several years until we get to where the true rate is. Now, this is all brand new for everybody. So the way 2.0 is working, it went into effect October 1st for anybody who is not currently in the National Flood Insurance Program. So it's for folks coming out of the private flood market that are now moving into it. You all were in the private flood market until last year, and that was very painful, right? Premiums were almost double, but we had no choice because we were being non-renewed by Voyager, who was a private flood carrier. There are a few other private flood markets out there, but they're all essentially drying up. They're just realizing that locally they've made their money, they're saturated with their risk, so they're starting to pull out, and that's oftentimes how those programs go. The NFIP, although rates are going through the roof, right now they're still the most affordable. My personal prediction is probably in the next year or two, as people keep getting these huge rate increases, it'll create opportunity for more flood insurance market or private flood insurance markets to come into the marketplace. So
Question number 2 is on the flood maps. We'll go to those in a little
yep,
bit.
I printed a couple of those and we'll share those on the screen.
And you just started talking about October 1st in the 2022, and you got a handout on that.
Yeah, so that's really what I was just talking about. You all are not subject to the October 1st deadline. You'll be subject to the April 1st deadline. So for those folks who are renewing with the National Flood Insurance Program, they already have policies with them. If they're renewing between October 1st and April 1st, essentially the system is going to rate them both ways. They can use the old rating system, the current rating system, or the 2.0 system. So whichever one is more beneficial, they'll use. Not every single one that we've quoted both ways has been more beneficial in the old system, but I would say at least 90% are better in the old rating system versus Flood Rate 2.0. At least 90%. We've had a few towers that we've quoted that have actually gone down, but not garden style. I'm not necessarily sure why that difference is, but those are the only exceptions. There's just a few of them.
Okay.
So April 1st is when we'll start seeing those increases happen. I brought a budget as well that I'll give you, and I emailed that. All right, question 4, are there any additional actions since we installed the flood vents? Structurally, landscaping, drainage, tiling, things of that nature. There's really not. The flood venting was key because in my opinion, that was really a construction defect. There were flood vents installed, and for a certain number of the buildings, they were actually compliant. There was enough square inches per square foot. The others were not. I don't know if they forgot, whatever the case may be. So that was great that you all recognized that you worked with the engineer to save some premium. As far as landscaping and things like that, other than being able to physically raise your buildings, unfortunately, there's nothing else that you can do. Your lowest floors now, which are your attached garages, are all properly vented. So you're taking advantage of the next lowest floor, which is really the living floor for all of your buildings.
For the coach houses, it's the top of the steps, I guess.
Yes, might be slightly higher.
Yeah, maybe the threshold higher.
Yeah.
Well, what's amazing with the elevation certificates is they are truly measuring, to the inch. And when you plug that information in, it rounds to the nearest foot, right? So if you get to 0.5, you'll get rounded up. So, we literally have scenarios
We'll
where,
dig some holes around the steps when they measure.
well, you can see where some of these elevation certificates, there's probably manual error if they're rating these to the actual inch. I've had other associations get updated ones, and I don't know if it's new technology or new equipment or what. It generally doesn't help them. Usually the old ones are more beneficial, just kind of an observation. So, yeah, unfortunately, unless they kind of expose some new loopholes for us all, there's really nothing y'all can do from a structural advantage. All right, what exactly does the association flood insurance cover? I brought a cheat sheet and I emailed it to you as
Yeah.
well. It's sometimes nice just to show it to your unit owners. There's 2 pages to it. One is for the flood insurance. The other, and it's really like a frequently asked questions. The first page is flood insurance. The second page is really for your hazard insurance, which is your property insurance. Think wind or
That's
fire.
3 sheets.
That is down here. This one.
So,
Flood insurance, and it's really just like a frequently asked
yeah,
questions.
okay. You don't know, okay. I
Yeah.
get that.
And the best way to think of that is essentially, there are some caveats between the 2 lists, and that's why we provide both lists. But generally, your rule of thumb is going to be your common elements are going to be covered by the association. The things within the units themselves, basically your finished drywall and in, that's on the actual specific unit owners themselves.
So when I looked at
Jeff,
the,
was this the, I'm sorry, go ahead.
no, go ahead, Karen.
No, my question was, is it the unit owner versus association responsibility, that second attachment you gave to us
Yes.
that you're
that's
referring
the-
to? Okay,
Yes, ma'am.
okay, thank you.
No. The cover page here, the first page, Jeff, for flood insurance shows things like baseboards, windows, crown molding, trim being covered, which compared to the peril insurance sort of goes away from that
It is different.
drywall in.
Exactly. So its flood is slightly different, and that's why we provide both lists. The reason being for that is it's just the national flood insurance policy is slightly more broad than the standard property insurance policy that's out there.
Okay, so that leads into next question.
Yep.
Owners in our couple town halls, like, hey, I'm in the
Third
second floor, third floor, do I need flood insurance?
Yeah, so I get that question all the time. The requirement is from the lender of your bank to have the flood insurance. Like they won't insure the loan. You can say, well, I'm on the second or the third floor. Well, that's great. That's for the interest within your unit itself. But remember, your unit is contained within the structure of the building. So if there was a flood and the flood damaged the building or the building was condemned due to flood or something like that, well, even if the water didn't touch your unit on the third floor, your bank still has no collateral, right? The unit is worth nothing unless the structure of the building is sound. Maybe a comparable thought of that is the condo collapse over on the East Coast. You had kind of not the sister building, but a connected building that didn't collapse. All those units are condemned, right? So the insurance, they have to have the insurance on the whole building itself. They can't just insure the first floor, yada, yada, yada. So
This bank thing, the other night we were sitting here and I think there were coffee last week. I think there were 7 or 8 of us here. I'm the only one who has a mortgage on my property. Everybody else thought theirs had no mortgage.
yeah,
And they're all upset about why do we need flood insurance? One guy said, I live up in New Jersey, right on the flood zone, and I don't have insurance. He's willing to take the risk.
yeah,
But the other guys in there may not be, and I can't. My bank says I have to have it.
gotta have it. Let's just kind of a comment on that. Unfortunately, condo living is kind of a modern version of hippie living, right? Commune living, right? You do have a share and everybody else's shares the share in that building. Unfortunately for those folks, if there's one lender in the building and everybody else owns it scot-free, they're out of luck as far as getting it waived.
So I'm on the first floor of a coach home. So this covers me if my building gets flooded. But we also took out a flood insurance policy personally, plus our, homeowners insurance.
Sure, yeah.
So for me to take out my own flood insurance, what's your just thoughts on that? Because that's what some of the people are really asking is, okay, we got the condo association insurance. do I really need to have my own personal flood insurance?
So from a lender requirement, I don't think there's any requirement, because really what the personal policy that you're buying for flood, that's for your contents, that's for your television, chairs, furnishings, things of that nature, that the association has no financial interest in whatsoever. So yeah, more than likely, I highly doubt that your lender or your mortgage has a requirement for you to carry it on the contents, because the lender's interest is not in the contents. It's not in the TV hanging on the wall. It's not in the refrigerator. It's in the
But-
building.
So when you mentioned TV in the wall, let's say we unfortunately had a high water mark and TVs and fixtures got ruined. Is that your own personal flood insurance or is that your peril insurance?
Yes, so on a personal level, that would, if it's flood, if it's rising water,
Yeah.
that's gonna be your personal flood.
So
insurance
you have to
policy.
have if something like that happens.
If there's no
No,
requirement, you
yeah,
don't
yeah,
have
yeah,
to,
yeah.
right? It's more of just a personal risk.
It's an insurance policy.
Yeah.
Yeah,
I can tell you that, so we currently rent. There's flood insurance on the building in the condominium that I live in. We do not have flood insurance on our belongings, on our contents. We have renter's insurance. We have, an umbrella and things of that nature, but we don't carry flood insurance. That's me taking on that risk. That's my personal decision. We don't have a lender or anybody that's requiring it from us.
let's say I have the same, I have, my bank said you have to have it, but now that I don't think they've read the policy. But let's say that if there's water damage not created by a flood,
Mhm.
then that's covered by your own imperil insurance if you have it.
Exactly.
That's damage that's created.
For
For the building itself, the walls of the building, if there's water damage from the upstairs, the walls of the building have to be taken care of by
Exactly.
the peril insurance that we belong to, because we're only responsible from the inside of the walls.
Exactly. So a good hypothetical claim, and this happens all the time, is a pipe burst or leaks within the walls. So now we have different parties involved. The association has the building, they're responsible for the building. So their insurance is going to cover the pipe burst, it's going to fix it, the drywall and things of that nature, but the water also came in your unit.
Right,
So you're responsible for whatever got wet within your unit.
okay,
More than likely what happens behind the scenes is your insurance company, after they reimburse you for that, they say, hey, this was the liability, this was the fault of the association, and they do what's called subrogation.
right.
They turn it in, they go after liability. for the association.
But that's only that pipe inside the wall. The pipe like that connects your toilet or your ice maker,
Precisely,
association doesn't own that, because we've all experienced
precisely,
that.
precisely.
But the
Exactly.
toilet they do, because of the sewer pipe or whatever, that's part of the structure.
Again, it'll depend on kind of where the leak came from.
Yeah.
Yes, a backup and overflow from the toilet, you're exactly right.
Yeah.
Your water line going in, your
Oh,
grandkid
yeah.
kicks it or
yeah,
trips on it.
If you break the water line going into the toilet, that makes
Bingo.
sense.
So it's all about the details, obviously, of course.
Yep. Okay, well, let's keep moving
Yeah,
it.
good question.
Okay. I think we'll be talking about deductibles when we bring up those slides.
Yeah, I'll show you those.
Just 1 second before we go on, because this question came up also. If there's a catastrophic loss, you're covered, you provide us insurance both for peril and for flood. How do you determine who's paying what?
What it was.
Because there's deductibles that are different.
Yeah, so we went through this. You have, you essentially have two perils and two policies responding. Good example of this is, I work with a marina down in Goodland.
Mhm.
When Irma rolled through, they have these boat storage, they had a boat storage building. It's a metal building.
Yeah.
And when you drive down there after Irma, well, the building is twisted and laying on its side. The boats are in a heap.
Right,
They also had 4 or 5 feet of water. So
Yeah.
the question is, what knocked over the building? Was it the wind or was it the water? What did it first? Well, the engineers get involved and you have multiple perils. Obviously, we were advocating for it to be a flood loss because the deductibles were much more favorable than the wind deductibles. So it was multiple perils. Both insurers actually shared in the loss. They somehow determined, what the percentage was.
okay,
Good-
say
good
60,
luck.
40, and then the deductible flows with the determination of
Es-
who was responsible. That makes sense.
Essentially.
Yeah, okay.
essentially. And it's, multiple peril is a mess.
But you don't know until it happens, until the engineers and them get in there and argue and decide, and then you, okay.
Exactly. Yeah, multiple perils is a mess and happens very, very rarely. But it can happen. Yeah.
Okay.
Hopefully it doesn't happen down here or up here rather. Okay, sorry, 7 we talked about there. Number 8, with current elevations, location and building type structures, what level of flood depth do you think could occur in the area? How much damage, et cetera? So again, I guess you're just asking for my personal opinion. What's our
Yeah.
risk here? This is what the flood maps actually determine. So you all are in an A zone, which is considered a special or a high risk flood zone. The likelihood the NFIP has determined is a 1% chance annually of us having a flood. They don't say if that's 6 inches of water or 3 feet of water. They just say there's a 1% chance annually of the flood. That's for an A zone. Again, we talked about it before. I don't know that historically, I don't think there's been a flood. I highly doubt it. I don't know if this was an inundated area before they developed it. We do have, was it Lakes Park just behind you there?
Yep.
So there's a large area of water. That doesn't necessarily affect your flood insurance because that's not what we call a floodway, right? That's not a river or a stream or anything like that. There are some estuaries, I'm sure, that feed into it, but it's really more or less a large holding pond. So that doesn't actually impact your flood insurance, but it's a good example of where
Except
Water
for the
table.
alligators come out because the water is too high.
yeah, right. And the gators start flowing over. Good point.
Relative to that, hold on. And I think we kind of hinted on that earlier. We have, you say we're in the A zone, but we have various elevations of the various buildings. Are there certain buildings that would not necessarily have to have insurance?
So you're still in the flood zone. So if you're in the flood zone, the lender is going to require it.
Remember,
The lender will.
right?
Now, as far as the actual rating, that's where that elevation certificate comes in handy. Because exactly, you may have, Florida is generally very, very flat, be different than up north. But we might have differences in building elevation, 6 inches or a foot maybe.
Yeah.
And that would impact the individual buildings. If we look at the schedule, even though there's only 2 types of buildings, there's 4 or 5 different premiums associated
Yes.
with the different buildings. And it has to do with the specific elevation of each building. Like we were saying before, they round to the nearest foot. So the
Right.
difference could be as little as an inch. If an inch gets you to 8.5 feet, well, now you're a 9. If you're 8.4 feet, which is what, an inch and a half, you're now at 8 feet.
So that could,
That's gonna.
like building 1 low rise
Mhm,
is X on the premium there.
mhm.
And then building 2, which is right next door, is a much less, which means it may have gotten rounded by an inch up.
Yeah, it could be as
Even
little as
though
a couple inches. different.
Aesthetically, when you look at this whole complex, you say, well,
You can't tell what's.
we're all
going on.
within inches of each other. It's just which inch rounds up.
Exactly. When we kind of dug into the whole flood venting last year, it's funny. So I first thought the elevation certificates must be wrong because they capture the flood venting. So I actually walked all your buildings and I physically counted the vents to say, hey.
I know we got that
these things
report and said,
wrong.
okay, jump through our ass. Thank you.
So I walked around and I forget which buildings they are. Maybe I'm disoriented. I think it's on this side. It's funny, as I stood in the driveway, I actually said, you know what? That driveway right there is on a slight incline. This driveway here is flat and it might almost be.
This one's right over
Yeah,
here,
it's
slips
Right
down a
over,
little bit.
right over here. So, yeah. So it's, you wouldn't think, who's gonna notice 6 inches? I stood there just thinking about it and I actually noticed it too. Hey, is that really gonna make? me-
And those are,
Flood out?
those buildings have a lower premium than the coach homes.
Well, these are coach homes.
I mean, the other coach homes.
Yeah,
Sorry, yeah.
which we'll get to that in a few minutes when we get to the schedules. Okay.
Yeah, we'll schedule. So good questions. Let's see, I think we're on question 9. Essentially, can we adjust the renewal dates so they're more affordable? I think what you're asking here is can you kind of shuffle them around the calendar
Yes.
so you've got more money in reserves? With flood insurance, the only way you can move a flood policy is for what they call congruency. So let's say we have April effective dates, but some policies are in August. They would let us go from April to August, but it's got to be the same effective date as another in-force policy. So I don't know that that helps you much or
Yeah,
not.
so when we look
Talk
at,
to 'em
when we
about
look at your list there, we have like,
First of March and April.
so our days of the 2 to 3 times the amount of operating cash in the checkbook
Mhm.
to, let's just say, pay and hold that grouping. So we have like 13 coach homes that all come due in March.
Yep.
And it's like, that's
That
just
hurt- that
too
hurts
much to try to
everything.
pay it in lump sum. So Lynn was, asking, oh, so it sounds like we could slide some of those out into the summer.
We likely could. Here's where it gets tricky with the NFIP. You pay them in full. Now you all utilize.
And you don't get
premium.
any credits if you,
Bingo. So even though you premium finance, essentially that policy is paid in full. If you're to move it in August, they don't say, okay, you have a balance of X and we'll just apply it. No, you have to write a new policy and pay it in full and then wait 2, 3, 4 weeks, maybe more, to actually get a return money.
But you will
so you're
get
out-
it, but you will get it.
You will get it. Yeah, as long as they agree to do it, you'll get it. And we would talk about that all up front. We'd say, here's the intention. This is what the association would like to do. And the underwriter will tell us, yeah, we can do it for congruency, or we can't do it for this stuff. Sorry, go ahead, Lynn. Lynn got a phone call.
okay,
Yeah, so if you wanted to do that, we would just communicate it up front with with those underwriters, make sure it all would work out. The one issue is you're essentially paying in advance. You'll get that money back, but it could be a month or so, maybe longer. It's
yeah, I guess
federal government. so-
if we just choose to make that adjustment and align, quarterly X number, so we potentially might have the operating cash to
just
not
pay.
finance as much
You just pay for it.
and just
Yeah.
pay for as much as we could. Then we get to ride that frequency going forward. And maybe level things out a little bit.
Yeah.
Because right now we go from
Well-
2 or 3 policies to 13.
Our biggest problem is not the flood insurance, it's the peril insurance, they're all due March 15th.
Because that's also March.
Yeah, it's
Yeah.
$122,000. That, it's very hard for us to cough all that up. We're gonna have the same problem with that as you're talking about with the flood. I think the flood could be a little bit different, but we've got policies with different dates on the flood. Why don't we have policies with different date on the peril?
Yeah, so initially, so what we're talking about is other than the flood insurance, I call this kind of the PNC, the property casualty.
Right,
So that all comes up March 15th.
right.
Generally speaking, there's no rules to whether or not you can or can't move it. You would just have to deal with potential cancellation penalties for not kind of fulfilling a full policy. But again, if the intention is to renew with the same carrier, typically an underwriter would work with you. I will say now, because the market is so hard, meaning rates are going up, the hard market, they're less flexible because they're essentially want to lock you in,
Yeah.
just in case rates go down next year, right? They won't hold you to it. And they also are usually not willing to offer an extension, a 16 or 18-month policy to get to where you need to go. Again, because rates continually are going up, at least they have the last 3 years. Forecasting to go up again.
We have of the 122, one of them's 83,000. So
Yeah, that's your property policy.
if we could shift that and leave the rest there, then we would essentially accomplish what we're trying to do to push, give us a little
Yeah.
break in cash flow, or vice versa. If we could move the other ones and leave the property insurance there, it's the same effect. But
Sure.
then we got what, 1, 2, 3, 4, 5, 6 different policies, but you
Yeah.
got crime and workers' comp and I mean,
Yeah,
those are
they're
probably
they're
not,
small, they're easy to handle.
so maybe we could consider doing something like that.
Yeah, we can certainly communicate with the property carrier. I will say this, the one downside to moving it, right? You're communicating with this underwriter ahead of time, and you're essentially agreeing with them that, hey, if you're willing to move it to August for us, you'll do what they call a cancel rewrite. Well, we can't go ahead and then market it to everybody else in August. That underwriter is essentially giving us his word, they're gonna do us a favor.
So you gotta
by
stick with
rewriting it. So you're stuck with them.
Yeah.
So there could be an increase there. So what you're losing
it's
is
flexibility.
potentially the competitiveness of the other players in the market. So if you want my opinion, I know cash flow is tough. I would say in the environment that we're in now, I would recommend keeping the March policies in March. I know you don't want to hear that. That's a tough thing. I just worry if that could upset it, especially how volatile the market is right now.
Yeah,
I think it's more valuable to say, okay, we're going to get this renewal quote and we can market it to the other various carriers
but we can't do that till
for
we
competition.
settle the claim.
That's another thing.
Yeah, which
You know.
is-
Okay,
And your job
So-
memory with open claim, they might not be willing to
Okay,
do a whole lot
so
of favors, but we'll see.
along the same lines, we're assuming, and I think somebody answered this before, we're assuming we can pick and choose which of those we care to finance if we can't pay them all.
We certainly can.
Yeah.
Yeah, without a
Okay.
doubt. Yeah, if you decided, hey, we want to pay everything except the property, also we'll just finance that.
Yeah.
Right.
We put that, okay.
Absolutely.
And I also heard, Kim told me the other day that she checked with the office. If we have the cash 3 months later, we can go ahead and pay it off and there'll
Sure.
be some rebate of the finance charges.
Yeah, so it's just like paying off a loan early or a car payment early.
Yeah.
You save on those remaining finances charges that would have been charged on the balance. You know,
Do they advertise this on the basis of the number of months? Because your risk is the same every month. So like with a house, as you go, the interest goes down because principal balance goes up. But not with this. You're covering us for a whole year. There's no change in coverage for each month. So I would assume.
Yeah, you're right. I mean, the risk, yeah, in theory, the risk is no different. I believe that interest calculation is, if I remember my accounting, I think it's called a simple interest rate, right? So it's essentially the interest rate divided by 12, and they apply it each month on the remaining balance, right? So yeah, the
that
sooner
would
you
be-
pay
that
it
would
off,
be
the better.
simple, yeah. Okay, that would make sense.
Okay.
Yeah, That's
Okay.
the way I understand it.
All right.
Yeah, good question.
We're just, we're working through budgets, then trying to
Yeah.
make sure we can look at some of these things. Apologize for not having it on the list. But
No, that's good. That's why we're here. We can talk about these things. Okay, number 10, how are other condo associations dealing with the increases? Honestly, just like you guys, this is not a new type of meeting for me. It's been painful the last 2 and 3 years for the property insurance renewals, right? The property policy has gone up, depending on who we are, 25 or 30% each of the last couple of years. You have an open claim like you all, we'll see where it goes. And we gave you a budget at 30%, I think. It could be 50, it could be 100, you know, we just don't know with an open claim.
So let me ask you this, and there was a question that Karen had that I kept separate. So let's assume that we settle tomorrow. The insurance companies offer us enough money that let's get the new roofs on, be done with it.
Great.
And now come March for our apparel, we come up for renewal.
Mhm.
This last year, you gave us a detail of how many companies, nobody bid.
Yeah.
What
with open
would
claim.
we expect like in March if our claims were settled today?
Yeah, so let's say claim gets settled today. Before we get to March, you have brand new roofs on this building. What I would expect would be probably a renewal from the incumbent carrier. Let's just say 30% increase because they know they've got to stay somewhat competitive because now you're somewhat attractive. You have brand new roofs on your building. They don't look at you like you've never had anything wrong because you're still going to have a multi-million-dollar loss. But I would expect if you have new roofs, we'll have some other carriers that would likely put a bid out to us. They would give us a number.
In right now, this policy we're under because the roofs are damaged is actual cash value
Roofs are
versus
ACV.
replacement cash value.
Yeah,
New roofs on the buildings up for bid. We
they give you replacement cost
get the
valuation on the
replacement
policy.
cost value
Yeah,
back.
without doubt. So you get better terms. Here's the $1 million question. Would it go down from where it is now? My honest opinion,
Yeah.
no, probably not. Your incumbent is probably going to offer a 20 to 30% increase on their renewal. And that's them just trying to be competitive with where the marketplace is.
Okay,
So it's
Karen,
certainly not going to go down.
that was
Yes.
your question. Follow on?
No, it wasn't. I think the one thing that had me concerned is like when you do file a homeowner's claim, that's kind of follows you as well. I've never been involved in litigation at the other end personally. So I wasn't sure if the black cloud was going to follow us after we settled, but it just seems like it's playing against us, both in sales, where owners now, new owners, prospective owners, have to set aside monies that we're holding on to and only up to 90 days for what would in essence be the ding that each of the homeowners would get on their assessment. So there's some weird things playing against us when it comes to the roof claim. I just want to make sure I know what we're getting into going forward. And I get nervous because anytime there's underwriters involved, they're an unpredictable lot. And being able to come up with, they're never going to go down. It just doesn't work that way. But going forward, I just didn't want us to get hurt even further. And I don't know how to
Yeah.
protect us from that.
At this point, once once you, once you retain the public adjuster and you fight this
Mhm.
claim, at some point you signed or a board member signed a sworn statement of loss saying, the roofs, we've had an independent person look at these roofs, they're shot, they need to be replaced, we're signing this. Now you're in
So,
the fight. You
yeah.
gotta follow.
And
it
where
through.
we're at, Jeff, because we have two different carriers.
Okay.
So the clubhouse pump and gatehouse by Indian Harbor
Yep.
denied our claim, came back with a ridiculously low offer. And on December 21st, and I did at least with American Coastal for the coach homes, the oath under testimony under oath or whatever,
Mhm.
back in March. So December 21st for these buildings, the smallest group, we have a mediation session on
Okay.
December 21st.
So that's good. You're making some progress.
And on the big claim, our lawyers are, we filed suit because they denied us as well.
Mhm.
And we're just waiting to get all of their documents and then get a mediation, which is now going to be after the first of the year. So,
And that type of time frame is not uncommon. I think maybe we talked about it last year around this time. These things take a couple of years, 3 years to go through. We have some from Irma that hired public adjusters soon after the storm, and they're just now getting taken care of. It's going to be.
Jeff, is there anything,
Years.
with your experience though, with lawsuits and things that have occurred in the past, is there anything we can sort of do to push, short of taking a lowball ridiculous offer? Is there anything else that can sort of put this in a push mode to get it over with?
Unless you got some really high powered attorneys, honestly.
Now, and I mean, we're waiting months and months at a time in between to just get updates. Meanwhile, the clock's ticking. We've got a cloud over us. We're like stuck. I don't like not having a plan B.
Yeah, I hate to say, that's the risk when you hire a public adjuster, but that's just sort of the game that gets played, right? That public adjuster, they're doing their job, and part of that is dragging this thing along. And, they may not tell you that, but that's part of this, is
Well,
they want to drag it along.
I'm surprised you said that people that filed right away are just coming to terms, which is basically 4 years.
Yeah, so-
And
Right.
previous boards, didn't even file for 2.5 years after Irma, 30 months, just short of the 3-year limit. So,
So you're about a year into it. And once this gets settled and you get your roofs taken care of, it'll probably be another year from now, honestly. I would say probably the average for those who hire a public adjuster is probably about 2 years. It's probably typical.
that's, our lawyers have said it's generally at least 18 months.
Yeah. So I kind of
And
want to
then,
say,
Mike, maybe with that time frame though, I don't know that we have the right lawyer. I don't know how experienced they are on doing this, but maybe we don't keep putting this out there in front of the residents, talking about what we think the rates are, what the assessment may be. We just kind of put it to the side. We can't do anything with it this year anyway, and next year is now really kind of questionable. I know
Yeah,
it makes people nervous and it gets them angry.
Yeah, well, I guess the owners, there's always someone that asks.
Yeah,
But anyway, we'll just,
and I don't think we can ignore it though, Karen.
I'm not saying ignore it though, but I'm not saying we keep putting price tags on. We've gone from 1,500 to 2,500 to over 5,000. We keep changing numbers. And I think that's the part that people feel unsteady about.
It's a simple math calculation. It's not going to change. It's the amount of deductible you decided to pay or not pay. So that number is not going to
I
change.
I
understand. I
think
understand that
that-
constantly putting something in front of someone without answers doesn't make a lot of sense.
well, I put those numbers out there with, just based on where we're at with the 2022 budget. We were looking at maybe a special assessment, Jeff, at the end of this year to cover some shortfall. So it was just to put it in the big perspective. So yeah, Karen, going forward, we won't be talking about special assessment rates or any of that. That's a done deal. We'll just talk about the timeline.
Right. I think
Good
that
point.
makes the most sense.
Okay, and then I think the last question, Jeff.
same deductible on all buildings? It is, and it's a fairly low one. I think it's $1,250.
Yeah,
Here's, that's actually a good segue. I'll pull up here.
okay, so where do you want me to go to, Jeff?
So do me a favor and pull up.
I think, before you go on, can I just comment on that question? Because it was mine.
Yeah, let's
was
open it
Louis.
up for follow-up questions.
Yeah, sure.
Yep.
do we have to have the same deductible on all buildings? I know we do right now, but do we have to?
You certainly don't have to. I would say, I don't want to say every association, but I would bet probably every association at least has a consistent deductible with all their buildings. I don't know why that is, probably because they don't have a great reason for why they would have a higher one on a different building. I don't know.
So, and Jeff's got a few slides, Christina, that I given him one to sort of fill in the blanks for us, and we'll bring those up in a minute. You know, but to your question, we potentially got three groupings. We've got coach homes, we've got 5 low-rise, and then we got the clubhouse and the pump house.
Right.
You know, so if maybe as we go through this, you know, we might be able to save X thousands of dollars by just increasing the deductible, and we
Yeah.
may standardize in between those three groups.
Sure. Yeah.
If that works.
Yeah, no doubt about that. Yeah, there's nothing preventing you from picking different deductible options. Let's start with, why don't we start with the slides? You know, because I
Yep.
kind of recreated, well, you know, you sent me one real good template and I tweaked it a little bit.
Yep.
And I created 2 more, just,
So we go to those first?
yeah, let's go to those.
Okay, here we
I
go.
only saw 2, you have 3 now?
There should be 3 in that attachment.
Maybe I
Oh, no, that's not it.
thought there was only 2.
Just 1 minute, guys, here. I gotta find the right,
I think it's that one, the flood insurance data slides.
yeah, they're all 3 in one group.
There we go.
Can you guys see that?
No,
Maybe it's coming up.
Yeah, we still just see your file folder there.
Huh.
See it now?
No.
No, it's the same. You might want to
Really?
just stop sharing and then
Yeah,
share again with
that's-
the different
That's
file.
what I'm gonna do.
Yeah, I basically picked.
Yeah, there it
Okay.
Each of those different categories.
Lesson learned, if you bring a slide up and a big pause, go out, come back in. Okay,
Yeah.
this is building 24. Jeff, I'll let you talk to it.
Yeah, so building 24. So you guys probably saw this, but what Mike sent me was essentially this slide, and he had some information on there. And I think what you all are trying to achieve at your meeting is to show this is a particular building, what it costs us now, and here are the different deductible options and where the premium would be. So what I did is I filled this in with the deductible options from this past renewal. I think this renewal was, I think it's April. I don't have the list in front of me. Let's assume this is an April renewal
This would be like in March.
or a March renewal. There we go. So the current premium is $4,703 just for this particular building.
April 7th.
Okay.
April 7th. There we go.
There we go.
And essentially what we've done, and this comes right on the quote. I've got the actual quote. This is 14,920. Right on the quote. All I did was fill in his slide. And it gives you basically the different premium options versus the deductible that you were to take on. So as you follow it left to right, you see we've even filled in, we have yellow, what the new premium cost would be, and then the savings versus where you're currently at. So you're currently at number 1, a very low deductible at $1,250. And I will say this, most of the associations I work with are relatively low deductible. Some go above 5,000, but I'd say most are 5,000 or less. And the reason being is you'll see it here, you know, depending on who you are, there is a lot of savings or not as much savings, and it actually depends on the building too. In this case, if you were to go all the way up to 25,000, you know, your premium goes down to $2,794. So your savings are about $1,900.
So guys, we're not gonna make any decisions today because this isn't a board meeting. But for example, I just took $5,000 deductible.
Yep.
And
Good round number.
so regardless, anything over 5,000, we pay for it. So one building, if we only had one building flood, you know, you divide 5,000 by 174 and it's chump change, right? It's like $28 a piece. And if we take 5,000 let's say 10 buildings on the back lot line, all get hit, it's $50,000. And we divide by 174, the special assessment would be around $290 after a major flood.
And that would just be for, like you're saying, I think you said 10
10
buildings.
buildings.
And when you're having these discussions, and this is totally a decision for the board to make. You're having these discussions, just keep in mind, the odds of it affecting just one building are extremely low, right? If we have a flood with enough
Right.
water to one building, it's very likely going to be multiple buildings. Maybe not all, because I think your larger buildings are a little bit higher. But it's very likely going to be multiple buildings. So that's probably the right way to think about it when you're talking about this analysis.
Well, I'd be all the high rise because their first floor is right on the ground, basically. I mean, if it's not high enough to go into the coach houses, it probably is high enough to go into all of those. So if one of those get flooded, be close to all of them and have a good chance of being flooded.
Yeah.
But the coach houses may not. But again, it's the elevation. You gotta understand, this is 8 inches taller than that, you already got it built in the mount, but this has the 2 steps, whatever the distance is.
Yeah, exactly.
Okay.
Not to get too off track here, so this particular slide, in my opinion, this was building 24. This was actually pretty good savings from a percentage standpoint. If we go to a different slide, let's just.
Jeff, before you move off of that slide, though, the owner's repair responsibility happens to be the same as the deductible on this. Is that the norm on all of these?
When I say owner, Karen.
It says owner's repair responsibilities, 5th line down.
Yeah, the deductible.
You have to pay the deductible.
No. It's not the deductible, is it? Is it it's a duplication or no? I'm just
No.
confused why there's 2 line items.
Well, the top line here, Karen, 5345, is just the deductible. And then it shows what the premium cost would be, what the savings would be. And so that means anything over $5,000, we would pay.
No, the insurance would pay.
Yeah.
Over
The insurance would pay, right?
5,000 unless we pay.
Yeah.
And what we didn't plug, oops,
I think it's just reiterating what your deductible is, because you're
Right.
responsible.
It's duplicating.
Well, yeah, it's reiterating, just. to
Yeah,
And I don't
highlight
know
it.
that that's needed because it looks like the owner now will be picking up the deductible. And that's not
Okay.
what you mean.
it's, yes, it says owners. So if I took this slide, now that I got it back from Jeff on the bottom line here. If I
I
took that,
lost the slide, Mike. It's gone.
Let's say, guys, yeah.
okay,
I think this. Yeah. Now
It's just
now
presentation.
reshare.
okay. Let me know when you can see it.
Can you guys see?
Okay. No.
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 Okay, just 1 second here. Okay, it
There we
should
go. How
come
about
back
that?
up.
That's back.
Yeah, we see it now.
Okay,
Yeah, we
so
got it.
Karen, what's not filled in is the bottom row here. So if we took that $5,000 and divided it by 174, that number, like $28 or something, would show the, across the bottom, the various special assessment impact. What could we absorb? And 5,000 just for one building.
Would it be a similar savings for all the buildings or is it pretty varied?
Mhm.
Like, is this the most we would save and then some are a lot less?
So that was going to be my next comment. This particular building, I think if you were to break down to a percentage standpoint, is pretty attractive savings, frankly. As you scale up the deductible, the savings are pretty
Right.
good. Let's just click on slide 2 there, Mike. Let's just take a quick look at that one.
Okay, this is building 1.
So this is building 1, address is 14811.
This is one is 2558.
We still see 24 only.
This one is.
No, I see building 1.
Okay.
this is the one-
Yeah.
Oh, now I do. Okay.
One in.
So this is a bigger building, right? We're talking 3.8 million, so it's one of your larger buildings. The current premium is higher. Current premium is $7,186 at the deductible level of $1,250. As you scale this deductible, you go up to 3,000, 4,000, 5,000, 10, 25. You see the savings are are quite a bit less, at least from a percentage standpoint.
Yeah.
Even a dollar standpoint, really. I don't know what the reasoning is for the NFIP. They make their rules sometimes, you know.
And this is kind of why I was wondering if we can, on some buildings, have a higher deductible and some not, because for that other building, it might make sense to, but for this building, it wouldn't really make sense to go up at all.
Right.
Yeah, here, let's take this last slide that Jeff had. This is building 17, another coach home example.
The last one is 17.
Yeah, 25. Yeah, the 17 is premium is 25.58. And again, this is better savings than the last one that we looked at,
Yeah.
certainly from a percentage. So, you know, generally speaking, folks, you know, as a board, there's nothing to stop you from choosing what deductible options you want. Every single building, when it comes up, is its own individual policy, and it'll have multiple deductible options. So what you're looking at now is a snapshot from, I think this was April of last year when these renewed.
Yeah.
I expect as they renew this next year to be in line, right? I don't know what they're going to be. We can't quote them that early yet. We can only quote 90 days out. I expect it to look fairly similar as they come up. But what we can do is we'll give you the actual quote options or deductible options. And I don't know if you want to do it on a case, it sounds like you would be interested in doing it on a case by case basis.
Well,
Just
there's,
take a look at those savings.
when we go to the one slide, Jeff, and you'll see like those 13 buildings, all at basically $4,700.
More than likely, they'll probably be the same.
It should
coming
be
up.
pretty similar.
And I would imagine the deductible options will be the same as well.
Okay.
Yeah.
So just for you guys to think about. So. And we'll send out some email because we're not gonna make any decisions today, but for every $10,000 in reduction of cost, that shaves $5 off the monthly fee. So if we took all 26 buildings, just the homes, and said, let's say we save $400, you know, in per premium, yeah, that's $10,400. You know, so we'd have to go, if we averaged around $400, now the fees would go down $5. So not $575, but $570. So you have to shave quite a bit of money to make a dent in the monthly fees.
Mike, I'll show you this example. I didn't email this to you all because this is another association I work with. So I just printed it and I took the name off it. I can't leave it because the addresses are there. You figure out who it is. But essentially the conversation I had with them, they renewed August 2nd. The conversation I had with them in July is very similar to this with deductible options. All of theirs come up at the exact same time. So when we got all the quotes in, we did a quick spreadsheet comparison so they could see they're currently at a $5,000 deductible. Depending on the type of building it is, it's either $7,800 in premium or, you know, $5,000. And then we give them 3 different deductible options: 5K, 10K, 25K. They wanted to see, hey, what if we went to 25,000? Well, their total savings, and they're similar to you guys, right? Their expiring renewal premium for flood was $178,000. At a $25,000 deductible, it brought the premium down to $148,000. So that's just kind of a snapshot of another association.
30,000.
So they save 30,000. It's about 17% on their premiums. They looked at this and they said, wait a second, we've got, count these buildings, there's 22 buildings, I think.
Close.
23 buildings. So they looked at this as a board and just talking through their decision-making process. They came to it very, very quickly. They said 25,000 times 23 buildings. If you do that math, it's pretty significant. And they said to save $30,000, we don't want to be the board that makes that decision. And God forbid there's a flood, you know?
Yeah.
Yeah, I mean, for us, it would be, I think, 650,000.
Yeah.
If we had a complete flood.
Divide that by 174, and what's your outgo going to be?
Yeah, this one is for a special assessment. If all the buildings got 25,000 above, well, less than 25,000, it'd be like a $4,200 special assessment per unit. to recover from that flood.
All to say $5 a month for a couple of years, maybe.
So that's essentially how they looked at it, you know. But it was really interesting, and, you know, yours come up at different times, but what we will give you is just like this. I think you printed this. This is the actual quote. Shows you the premium at which deductible, and it gives you what, 7 different options. And we'll give you this with each one that comes up, and you can do it as on a case-by-case basis.
Well, the one that you showed us there, that Mike has in front of him,
Yeah.
did they end up taking the same deductible for all the buildings?
Yeah, they kept it right where it was at a $5,000 deductible. Yeah.
One of the things I think we should caution ourselves, because I heard this at the coffee last Thursday, is that several of the people said, well, why can't our building have one deductible, somebody else's building have another deductible, thinking
They're gonna get a windfall for themselves.
they were going to only have to
Well-
pay relative to that building. But, you know, nobody, if we ever start doing that, I'm out of this complex, you know.
I was gonna say, you know, that's
Assessments by unit. you
That's
know?
up to your bylaws and
Yeah.
probably a good question for your attorney.
Yeah.
You know, yeah, you get
Yeah,
it.
you get
You
some
get some
hairy
acceptance.
things.
Yeah.
Okay, let's go around the room. Dick, because this will basically wrap up deductibles. Any
Yeah.
question, Dick, from you on deductibles or just perspective? And then we'll go to Karen and over to Lynn.
Yeah, I think it's worth looking into. There's for these the carriage homes, it's some significant savings there. You know, I don't know if I'd be comfortable going up to a $25,000 deductible, but at 10,000, that's a huge savings. I think it's definitely worth looking into when our renewals come up, and do it on a case by case, building by building, and just see what we can come up with, because it's, for every, like you said, for every $10,000, it's $5 a month. If we can shave 30 or 40 grand off of that bill, it's, $15 or $20 a month savings. So I think it's definitely worth looking into.
Okay, Karen.
I would I'm certainly willing to look into it, but I just caution you on changing deductibles. It's a good time now. We're kind of healthy when it comes to building structures, but when you get stuck at the end, it is not pretty. I'm pretty big on overinsuring. So I come from that world, and I know they get you at either end. So you got to be careful. You can't just change it.
Christina?
Yeah, I guess I'm kind of in between. I think that we probably could, I think a case by case basis is the way to do it, because if we're only going to save, $100 or $200, it's not worth it. But,
Right.
if we could save a significant amount where it would actually impact fees, and we could maintain an acceptable level of risk with a $5,000 to possibly $10,000 deductible. But I definitely don't think we should go up to 25,000, and we would be looking with a flood that affected the whole community. We would be looking at a close to $4,000 assessment per unit. And that would take for saving $5 to $10 a month, it would take like 30 years to earn that back in savings. So
Okay, Lynn?
Yeah, I have I just don't think that we need to have the deductible too high. Maybe 1250 is too low, but I think we need to run some scenarios, and when you talk case by case, I think if we're going to do this, we have to decide a scenario showing the same deductible for all buildings and run that. And like she said, let's see what the payback is. If you're going to save $5 a month, 10 years, it's going to be 40 years to get your money back. If you have that, to me, the risk is not worth it to me. But I think if you want us to, we could probably do something like that. Run some
Yeah.
scenarios.
So I'll try to make it to 3 points. So number one, in my mind, I think the $25,000 is off the table, period. 2, I think probably in the middle of the road might make sense. And lastly, I have a higher deductible on my car than I do on $1 million building. So I'm willing to eat $1,000, $1,500, $2,000 on my car to maintain insurance premiums. I'd have at least that much on my building. So I'm going to ask Jeff to do the same spreadsheet don't even put 25,000 on it.
Yeah.
If you all agree, and then we'll take a look at it, and then Linda, your point exactly, the slide, that's the reason that, then we could basically take the slide and fill in the amounts and say, okay, worst case special assessment to recover from a flood. And you can see, what's that mean to me as an owner, or, to the board to make a decision? It's sort of like the roof. They had a 2% deductible on peril for years. Then they went to 3,000, and what happened? Irma.
Yeah.
So we went from $660,000 deductible to $932,000 deductible. But again, it's still, if it all comes in at $932 deductible, I say it's only a $2,500 special assessment, and we have all new roofs. And go forward from there. So, okay. Anything else on deductibles, Jeff? And then we'll move on to some other slides.
Like you said, as these policies come up and they kind of come up in chunks, what we'll provide you is the actual quote with the deductible options. So you all can, as a board, make a decision, and happy to consult with you on that. So we're all on the same page.
And I think that, like, when we were talking about a case by case basis, I don't think that, it still wouldn't change the assessment. Like, if there's a lower deductible on one building, say building 1, because it didn't save us any money, it would still be the overall scenario. Like, we would, as an association, be still paying for that deductible. It wouldn't be like people in building 1 don't have to pay as much if a flood affects the whole association. It just might lower our risk if there was a flood, a catastrophic flood for the whole association.
Okay, Jeff, what would you like to look at next?
I think, because I know we've covered a lot. One thing that's fresh in my mind I'll talk about, we're changing gears a little bit, but still on the flood insurance. Let's talk about appraisals. So I'm going to pull up here. I have the appraisal.
Hey, Mike, I'm sorry. How long I thought we were just going an hour. Are we going longer than that?
Sorry, I know we're over.
Yeah,
I've got no.
Right.
I don't want to hold you guys though. So if there's specifics, let me know.
No, I'm gonna have to leave, and I've got to leave in like 15 minutes to get Lisa at
Okay.
PT.
no problem. Well, I think
Okay, go ahead.
it's up to you guys, we can keep going. We're recording this so that, I know I'll probably go back online and listen to it again and that. So as a minimum, Karen, you won't miss anything.
Okay, that'd be good. Thank you.
I'm going to make a really quick point just on appraisals. So we've seen this come up a few times over the last week or so. So just to recap, what's the appraisal? There's a third-party insurance appraiser. That's where we come up with the limits of insurance, the values of your buildings. You guys have that refreshed every year, which is very, very, very common. Essentially, they're refreshing it with current replacement costs if there was a catastrophic loss. What we've noticed is one particular company, and you guys are using them, Townsend Appraisals. And this is by no means a knock on Townsend, because they're probably the most common appraiser in the area. Typically, year over year, any appraisal, and Townsend included, has been, essentially your reconstruction costs would go up with inflation. We're talking 2, 3, 4, maybe 5% on an annual basis. Typically 3% is about the average. The last 4 or 5 weeks, and we got a letter from Townsend as well, they have increased their appraisals by about 15%. So it doesn't mean that Townsend is now appraising at a higher value than other companies. They've always been a little low, in my opinion, give or take 10 or 15%. So they're probably about even with the other companies. But why is that important for the associations to know? Well, we used to be able to bank on a 3% increase in the cost or in the replacement cost of buildings. 15%, if you're already getting a rate increase plus a 15% increase in the actual values of the building, well, now we're compounding here, and that's something that we haven't seen in the past. It's something that we just came across really in the last month or so that we saw, and it was a red flag that went up because it started blowing people's budgets out of the water.
Yeah, it's like a $5.4 million increase on this property.
So
if they go up 15%.
So I don't know that they're definitely going to do it, but that's what Townsend's doing. So that could be coming down the pike, and I just want to put it on your radar.
but that's what's happened right now with COVID and everything. You can't get materials.
Cost of
You know,
construction is going through the
People are
roof.
stealing materials right out of the
Yep.
building sites and, it's gonna be a while before
Yeah.
we see anything
Okay.
happen there. But unfortunately, what may happen, the price of materials will stay up.
It could.
It's just,
Last comment on appraisals, you're not required to have it done every single year. The statutory requirement is every 3 years. It's every 36 months you have to have it refreshed. You guys do it every year, like many associations. And the reason being is so that you don't have a gap. Hey, if you let 3 years go by, no doubt it's going to cost more to rebuild your building 3 years from now than it does today. Assuming this isn't a fake inflationary spike. I give that to you for what it's worth. If you feel like this is a short-term inflationary, maybe you go a year without refreshing the appraisal, or maybe you wait till next year, or maybe rates will go up. I don't know. You can be creative. as a
because the
board if you
appraisal
wanna
is
do
how you
that.
set the values for the policies.
Exactly. Yeah.
So,
They give it to us and we just literally hand it to the insurance company. That's where it comes from. Yeah. So just something to put on your radar. That hasn't been on anyone's radar in the past.
well, let me ask you this, if you don't do it, let's say you do it every other year, and your replacement cost, does it matter what the appraisal is at that time? Because 2 years from now, the replacement cost is gonna be higher. So why should we pay higher insurance if we don't get an appraisal? Just wondering out. I'm a finance guy.
You're picking up kind of where I was going with this.
Yeah, okay.
I can't recommend that you don't get an appraisal every year. But the board's decision is it must be done at least every 3 years.
Every 3 years.
Here's the
Yeah.
downside. If you do not refresh your appraisal and there's a loss, the market price to rebuild your building could be significantly more than what your buildings were insured for. There's no insurance to make up that gap.
Yeah.
So that's the risk. That's the actual risk of the association
Uh-huh.
is that
But
gap.
up until that value, any replacement cost, if we have something, we have several buildings, they're gonna fix it because it's
Sure.
under the umbrella.
Exactly. Yeah, they'll pay
Or
you,
Under the upper limit.
they'll pay you up to the limit
Yes.
and no more
okay.
than that.
Yeah,
Exactly.
okay.
Yeah, good question. Good question. man.
Yes.
Yes, absolutely. That's just one page out of the appraisal. It's kind of a snapshot of.
This
buildings.
was in your package, right?
I don't know that I emailed this
Okay.
because I thought about it. going out
That
the door.
wasn't.
Yeah,
Yeah, that wasn't.
this I thought about going out the door because I've had other conversations about.
So
it.
let me just ask Jeff here. So we've got some flood maps. Then we've got like the worksheet right there. He shows our projected cost for next year for 2022.
Yep.
Which you just tell me what you want.
I'll say, let's not shy away from the budget. Let's go to the flood budget that we put
This one?
together. Yeah.
Can you guys see my screen?
No.
No,
Okay, let me refresh.
Is that this one?
Yes.
All right. Let's see, I guess I gotta get out of here.
Two, okay, yeah. Okay, we have all these. And then we did 20.
Like, I wonder, yeah, I wonder if it got minimized. Here we go. Like, let's do this. Let's just click on screen there. There we go. So now it's going to show whatever you pull up. Should.
Nope.
Can you all see the screen now as he's going through?
No.
I'm gonna pause here a second. Can you see my screen?
No, we just see the list of files.
Okay,
Okay.
yeah, let me open that one, then the budget. See that screen?
The flood policies and projections, yeah.
There we go. Let's make that a little bigger format. Click that box at the top right. So what you're looking at here, folks, this is just spreadsheet of just the flood policies. This is each building, when they renew, include policy numbers, 21 to 22, This is what you're currently paying, because I think everything as of 9/28, they've all renewed in 2021. And then the final column there is the 22, 23 estimated. Where'd that estimate come from? Again, we were talking about the flood 2.0 rating system. What we're seeing is flood 2.0, the new rating is significant increases. The cap for current policyholders is an annual cap of 18%. So even if your true rate is 2 or 3 times what the building is paying now, you can only get 18% annually each year until you get to that
So
true rate.
this is then an adequate, a suitable planning figure for our budget.
Yeah, I would look at this, and my intention with this was to say, this is the way we understand it, a worst case scenario with the flood insurance costs. Here's the reality. Everything that renews prior to 4/1 is going to be subject to whichever is more beneficial, whether it's the old rating or the new rating. So I wouldn't be surprised if those first, was it 6 or 7 policies, maybe 8 policies, wouldn't be surprised if they are not at the 18% cap. Maybe they're less. They could be 5 or 6% like we've typically seen the last several years with flood. But the rest of them, we just don't know, because we're not in a position yet. We're not close enough to be able to quote them. So my guideline is, let's plan for the 18%. And if the National Flood Insurance Program comes back at 6%, 10%, 11%, whatever it is, okay, you're ahead of the game. We should budget it safely.
When we talked before about possibly moving some by doing like a cancellation and rewrite, would that rewrite be under the old policy, or would that bump us up to that new 2.0 plan, like right away?
So that's a great question, and that's on my list to find out before we just go ahead and pull the trigger on a move. Because again, with flood 2.0 being so new, the rules have essentially changed, So yes, we don't know, but that we'll find out.
Okay.
Pull the trigger on anything. That's a good question. Yeah.
Okay, comments on this slide from anybody?
Yes, the guy who's doing the budget has a question.
Okay.
So this is 21-22. Are you sure? This is not 2021?
Right, 2021, that's what it is. So the
No,
reason we
no,
put
it's-
22 is they're sorry, they're all 2021 really.
Yeah, because this is the, for budget purposes, I have to allocate the cost over 12 months. So if the policy comes in September, I don't want to be running that whole cost for the whole year. I just want to run it from September forward.
Gotcha.
And this is a column that we are now under for 2021.
Yeah.
And this would be 21-22, because policies come into effect at the end of 21. So I think, I just have to think about this, but I have some differences that I'm gonna have to sort out,
Okay.
which could affect the budget. Okay.
Yeah, there's
Yeah,
like
that's-
that first
that's what I'm
policy
thinking,
in
Ed.
February or so, we
Like-
gained two months of cost under the
The old
current
policy, right,
divide by 12,
right.
and we pick up 10 months
Right.
under the
Under the new.
far
budget.
right column.
I see.
So for expense purposes, I have to look at that, because that's what our expense, cash purpose, I have to look at this, because we have to have the cash on hand to pay it, so.
Yeah.
So that's why I was asking, but
Okay.
I see some discrepancies that I'll talk to you about offline, so I can make sure I've got the right numbers.
Yeah, that's fine.
Okay,
That's good.
Okay. Any other comments on this slide, guys? Okay, what would you like to pull up next,
Let's
Jeff?
pull up the file right above it, the budget, because this is the other budget. So there's really 2 parts to the budget: the flood insurance budget, and now we have what I call the P&C budget. So this is your standard property insurance and your other lines of coverage. These all come up in March. Before flood went crazy, the property policy for the last 2 years has really been kind of a wild card. It's been going up really anywhere from 20 to 30%, depending on the association. Those with open claims are really sort of a wild card. I think I used exactly 30% on the increase for the property line. The reality is, until that roof gets fixed and we get some other quotes, we'll just see where it is. It could be 50%. I mean, I hate to say, but it could be 100%. there's not necessarily a cap on what they can do for you. So we'll see where that goes. I use 30% just as honestly a kind of a guess there, because that's what most others I'm using. The other lines of coverage, I think we're either 10 to 15% because we've been seeing those lines of coverage go up as well.
Jeff, can you tell me what umbrella is? What is that for?
Yeah, so your umbrella, it's a liability coverage. It sits over your general liability, your directors and officers.
Okay,
And the package, which is the general liability. So it extends the limits of liability above and beyond those policies, sits on top of those policies. Good example would be, let's see at the pool here, there's a slip and fall on wet
Mhm.
paper. Somebody's injured, they sue the association. It's the general liability policy that would respond. You get $1 million for any one occurrence as part of the general liability. If it was a severe injury and it's more than $1 million, then it gets into the umbrella coverage.
okay,
And the umbrella limits are.
okay, thanks.
Various types, right, are the same.
Um,
I don't remember.
off head, I don't want to guess. I
Okay,
don't
no, no,
remember
no,
what
okay,
your
don't worry
umbrella
about it.
limit
No,
is.
don't worry about it.
I didn't bring the summary.
No problem.
So
Okay.
anyway, I just wanted to show this to you folks. The overall, currently the expiring is at 98,000, other than the flood. I'm forecasting somewhere in the $122,000 range. And again, it's not you all. Frankly, the property policy it could be more than that. We'll see what the carrier is going to give us while you're in litigation, with roofs that need to be replaced.
Yeah, and our current budget, Lynn, we had like 117,000
No, they have these numbers.
for the peril.
We got 122, very, well.
Well, it's gonna be,
117 with the expense, not policy, not on this format. It's because we spread the expense out.
yeah,
So for next year, it's 117, it's not the full 122.
right.
Yeah.
Okay.
But we just have to look at that 30% assumption number and then divide by
That's a real wild card. Yeah.
Well,
3 months
I was
versus.
gonna make a
8
comment
months.
to that, because I think when we went back in June and we were talking to you and we were preparing the initial pass-through,
Mhm.
you gave us 25%, 15 and 25. So if you're hedging a little bit more upward, we may have to adjust that a little bit. Just depends what. the
Yeah,
impact is.
this is the budget that was provided when we last spoke. So maybe I'm just misspeaking when I keep saying 30%. I can check this math here.
It was 24%.
24, okay.
So this is 24.
Mike, it's Karen. I'm gonna go.
Because I
Okay,
thought we
Karen.
used your numbers.
Bye. Bye, guys.
Bye-bye, Karen.
Bye, Karen.
Thanks, Karen.
Bye,
Because I
Karen.
thought we used,
Bye.
Yeah,
then we go start crunching numbers again. when
No,
we-
you're-
yeah, Okay.
you're exactly
So-
right.
So Mike,
Yeah, go ahead, Dick.
so just so I understand, so on the last two slides, the estimated budget 22-23, that 122,000 number there, that's the number that we need to use for this coming budget, correct? Or is this another year out?
We're gonna take, Dick, this first column for 21, 22, that 98.
Right,
divide by 12 months because the renewal is in March. So
okay,
Lynn will take like 2.5 months of the 98 cost prorated and then take 6, 7.5 months or 8.5 months or whatever.
yeah,
8.5
My
of
math
the
is not so good.
122.
okay. But this is for 2022, so this is the numbers that are being used for the budget that you guys are putting together for 2022. This isn't an additional increase for the year beyond that.
No,
No.
we
Oh.
just commented about, it. I wanted to make sure that we were in sync about the numbers that he
Right.
gave. And for the peril, we're right on, but I may be off a little bit, maybe to our
Okay.
advantage on flood. I have to double check.
Fair enough.
Okay. Christie, any comments?
No, nothing else from me.
I know, I'll just say in general, I know the budgets are tough at this
Yeah,
point.
yeah.
Everything is going up for every association. So you all are not unique. You have the claim, which is a bit of a wild card. But even if you didn't have the claim, you'd be probably looking at that 15 to 20% on the property piece. And the flood is what it is.
Yeah, what compounds it is we're having to transition last year from private to national,
Yeah, it hurt.
top of this roof, and now 2.0. So, just a lot of, as you know, a lot of anxiety.
Of course.
We had one more year of anxiety than maybe other associations
Yeah.
because of
Because of the
losing the
timing of
private.
it.
Okay,
Yeah.
what next slide here, Jeff, would you like to bring up?
Let's look at, since we're just talking about anxiety, go ahead and click on,
Maybe that was one of the true ones.
yeah, let's go ahead and click on basically the true rate. Let's pick one. That's what, 14,811.
I'm gonna hit that.
Sure.
Which one is it?
So we're looking at 14,811.
Okay, that's this, not one of these, because I didn't print everything.
This one here.
Okay, select the.
Yep, we've got the one on top. So what you're looking at here, folks, what we did is essentially what could be worst case scenario if you were rated as a new policyholder in flood risk rating 2.0, what would you be paying for a particular building? This is for the address 14811. I can't remember which building number that is. 14811.
14,811 is the, wait a minute,
Building 1.
building one.
So to give you an idea what the premium does here, at your current deductible level to $1 million building, current premium would be $20,675.
What?
That's what it would be if you were brand new going into flood risk 2.0 rating. So you
Wow.
see the difference. What you're currently paying today on the current policy is $7,186. So it's almost triple. That's 3x. So the reason I show this to you is we're kind of looking at this as what we're calling a glide path. So today you're at 7,186, and the figure I gave you was an 18% increase
Yeah.
estimated budget. We can anticipate we're going to get an 18% increase annually until we get to this number. And that's if they don't move the goalposts on us in the next, it's going to take 4 or 5 years to get there.
I noticed on the slide too
Number.
that you
I
had
looked at
showed
it
us
earlier.
Yeah.
for
So,
that building, that's actually a $3.8 million coverage on that building. So would that, if you were to move that coverage up to 3.8, would that then like triple that premium?
Yeah, well, let's see. I had my team just run a couple of them. I don't know if we did that one. The other building we ran and new was 14,920.
Yeah, 14,920 is building 24. I looked that up
Okay,
and so the one we're looking at right now,
this is 14,811,
building one.
okay.
building 1.
So that's actually, the building coverage should be like 3.8. This is same value coverage as a coach home.
Okay, so maybe we just ran it wrong.
Yeah,
Well, okay. So
even that number.
I guess still a
scary.
good, still a good illustration, right? Because yeah, this is at $1 million level. So where we came up with this is I had my team, I said, let's pick a couple of buildings. Let's basically trick the system into thinking this is a brand new policy holder. And that's where the premium came in at.
Per 1 million of coverage, would that be then?
Well, for that particular building at $1 million, the other one we did,
But let's say the value is 3 million or something, right? But the building one, yeah, 3.75.
yeah.
So, and you only gave us for 1 million.
Yeah, I
So you're
don't,
saying it's gonna be 3 times that?
I wouldn't say it'll be 3 times because in generally the way, and this was just a mistake on our part. So I know we're talking hypothetical. The higher dollars of insurance are tougher to get to, so they are rated at a lower rate. In other words, the third $1 million of coverage are less expensive than that
Sure.
first $1 million of coverage. It's just,
It's gonna
natural.
take really. get that.
It would take a real significant loss to get to that other limit.
So the other one that you sent out was for building 24, and it looks like that one, the premium for the same deductible we currently have for $1 million is $14,632 compared to,
Yeah. Here, I'll see if I.
compared to 4,700.
Is
So,
almost triple our current.
Okay, so
well, I
that's,
think that's probably over triple,
yeah,
or I guess right around triple, yeah.
yeah.
Well, it's 47, right?
Yeah.
Building 24.
And
Or,
Mike, I
I'm
don't
sorry,
know if you heard the comment I made, but really the reason why I show this to you folks is your annual cap is 18% year over year. So it essentially just gives us the glide path to see where we're gonna be, and I don't know how long it'll take to get there, 4 or 5 years. And that's assuming they don't, change these rates by then, which they could.
Well, that's something, I attended a webinar with budget planning or leadership 101, and, the bottom line was that most associations just deal year by year. And no one's looking strategically.
Yeah.
So like right now, if we said, hey, let's do our 3-year strategic budget, we know right now tentatively increase flood insurance year over year by 18%,
18%.
worst case.
Yeah.
And
So use that.
if we were doing 2023 peril, like IA new roofs are on at some point in time, potentially 20 to 30% on that premium rate.
Yeah,
Would-
and that one's harder to figure because just historically speaking, from, let's see, it was 2011 to the beginning of 2018, rates actually went down slightly. And then, oh, by the way, year after Irma, right, everything spiked. And we're really in year 3 of that spike. Historically, the hard markets, these spikes last 2 to 3 years. This one seems to be different than all the others. So it's a little hard to look 3 years out,
Yeah.
but be safe. You'd rather be safe than sorry. I think.
Again, it gives a heads up to anybody thinking about being on the board that, yeah, it's every year,
Well,
Could be
it's
painful.
gonna be painful.
and to follow your comments there, I'm just thinking out loud, if we're at 4,700 for building 24, right? So 18%, that's 20, to make it easy for the math. So
Yeah,
you touch
compound
almost
it out.
1,000 a year
And
over
it's
the
gonna-
next 5
It's
years.
gonna grow.
So that's 12,000, and we're still not to this number here, which is 14. So, it's gonna take 7 or 8 years to catch up, which is a
Yeah.
significant increase every year that we
Year.
have to consider. I'm
Yeah.
moving out. I'm gonna rent someplace.
Well, so the question that we're getting, and again, this is brand new, right? The literature that I sent out, that we blasted out a few months ago.
Yeah.
What the NFIP is telling agents is, forget the exact number, but basically 20% of policies are gonna see, a slight decrease. 60% of policyholders are going to see essentially a flat renewal. And then what was it? 10 or 15% we're going to see, thank you, Mike, a significant increase. Well, what we're finding out is it seems like all of Southwest Florida is fitting into that 15% bucket. If
Yeah.
What you're telling us is true.
Yeah.
But up until now, until we're seeing what the system is doing, nobody would answer those questions for us. We'd ask specifically, well, where do we fall? And they'd say, well, here's the chart. Well, apparently all of Florida is in that 11% bucket, unfortunately.
Yeah.
Essentially what we're telling folks to do now, because it's so new, this is all legislative, right? This is the National Flood Insurance Program. Unless they make changes to the legislature, I'm not sure where this goes. So what I'll send you after this meeting is
Contact the congressman.
exactly how to, I don't know how often that stuff works, but I don't know where else to go with it, right? Because in in 5 years, what we're gonna have is essentially no real estate market here in Florida, because it's gonna be too expensive to move down here. Even though associations like this have never had a flood, and probably won't see a flood in their lifetime. I don't
So
know.
when I was driving, I actually never heard about 2.0 until Thursday afternoon, driving through Kentucky coming down here in a short blurb on National Public Radio. It said that the federal subsidy of the NFIP ended on October 1st.
Yeah.
Is that,
Well, they just refreshed the budget. What was it?
It's because of the budget.
They had to repass the national budget. And it passed
Just
again.
just last Friday.
well, that article didn't say that.
Yeah.
I'm thinking, well, they're pulling up the federal government subsidies, so now it's got to be made up. That has to be made up plus more.
Mhm. Essentially, what's going on here, it's irrespective of the national budget, but what they're trying to do is get the program to a break-even point.
Yeah.
It's something like $30 billion in the red, and that just goes up every single year, just like our national budget. So this is their way of trying to.
65%.
Okay.
If we make up 34% of that, this is 30 million, would you say how much is 30 million? 30 million?
30 billion.
30 billion. 35% of us down here.
Okay,
Jeez.
Jeff, which slide next would you like to go to?
I don't know how much more time everybody has. If you want to look at a couple of flood maps, let's look at a couple of flood maps. So
Okay,
I basically picked,
here's
it's
where we're
it's
at.
really hard to see, and maybe we zoom in on it. I did basically 3 versions of the same map. I'll tell you what, Mike, if you go out, let's open a different attachment first. Open the overhead one, which is right below.
Yeah.
So this is like from a 30,000 foot view, right? You're seeing some colors on your screen and you may not be.
You guys see this?
Yeah,
Okay.
So this is a lot easier to use when you're live and you're on the website, but this is essentially kind of the snapshot of it. There's a little marker here on your association. This is essentially a 30,000 foot view. You're seeing some colors on your map. You can probably see kind of the outline of the actual land underneath. The colors represent the different flood zones based on the flood map. So the red is what we call a V zone. That's a velocity zone, right? That is high risk. It's essentially coastal. Honestly, most of these reds are basically marshland
Or by the river.
or by the river.
River here.
You know, the particular way this map showed, it's not including Sanibel or Fort Myers.
Yeah, I was
Beach in
wondering that.
this.
It's like,
It's just
Danville's a safe place to live.
some way the map was calibrated. They are definitely red. Okay, they are definitely V zones. There's no doubt about that. The blue zone, you guys are kind of in the eastern portion of that blue zone. That blue zone is an A zone. A is still a special flood risk zone or a high hazard flood zone. It's an annual chance that they've determined, however they determine it, of a 1% chance annually
Per year,
of having a flood each year. Yep. So you're somewhat close to the yellow, which is an X zone.
Which is what?
X zone is a non-special hazard zone. That's where you're not required flood insurance by lenders
which zone?
in an X zone. So the yellow and this kind of maroonish brownish
Okay.
color. So that's kind of the zoomed out. You can zoom in a little bit further, and that's all these maps are. As I just zoomed in a little further, so now we're mostly blue, and you can see kind of the edge of this brown. So we're probably, I don't know, if we're estimating, you're probably 2 miles west of the nearest X zone. So everybody around you is in that blue. And I do another that gets in a little closer. I don't know if you want to see it or not. It might be easier to see the association in the third map. Yes, it's that one. There we go. And here's the thing. There's nothing that as an association you can do to change your mapping. Years ago, there was these LOMARs, which is a letter of map revision. That was for folks in a V zone where they felt like, or let's say they're in an A zone and they were touching a V zone, because if any part of your building is touching it, you go in the higher hazard zone. So they were doing things like that to basically kind of, hey, the satellite is mispositioned. We're not actually touching that zone. And that's what they were doing. You could hire engineers to do it. And for some folks, if they're going from an A zone to a V zone, that could be 3 times the premium, right? Or more.
Yeah.
So in the news, like when I got down here, Wink News, and they're talking about this 2.0, the people on the coast, the super high risk are the ones that are really gonna get slammed.
It's the folks that own, and this was the intention of the program, it's the folks that have multi-million-dollar homes right on the coast, and it's their second home, they should be paying their fair share.
Exactly.
On the residential side, away from condominium buildings, because they fall into a different category, but on the residential side, the most flood insurance you can buy through the NFIP is $250,000. So if you, and a lender's requiring, right? So if you inherited your grandmother's house and it's a $300,000 house on a beautiful plot of land on the beach, you're paying the same if you're at the same elevation as your neighbor next to you who has a $5 million house, big, beautiful custom home. Well, you tell me, if each home gets 6 inches of water in it, who's going to have more damage? Probably that custom $5 million home. We're paying the same in flood insurance. Now that $5 million home is going to be significantly more. The collateral damage is folks like you all who are in an association 3, 4, 5 miles from the water. We're not you're not owning $5 million condos here. We're normal. This is Florida living, and we're all paying the price for it. So I don't know what the solution is going to be for 2.0, but I'm with a lot of people that I think over the next few years, it could really affect, in general, our market in Florida, real estate, people living here, moving here, the economy. So
And also living here, if you're going see a 18% increase for the next 5 years. Yeah, that's a lot of money.
Yeah,
Okay.
yeah. It could be substantial.
Okay, well, I think we've gone through all of our questions and more in pretty much all the slides that you've just seen. So let's just go around the room and ask Jeff any remaining questions, and then we'll just recap maybe a couple follow-up items and wrap this up. So Christina, I'll let you go first. Any final questions, comments to share with Jeff and us?
Yeah, I think I covered everything.
Okay, Dick?
I just want to thank Jeff for spending, all his time with us, his travel time and all, big chunk out of his day. And then just going back to, if we're looking at an 18% increase for flood for the next few years, and I'm guessing our hazard and peril is going to be going up, 20%. I just did, some quick math. For the next year, we're looking at a $55,000 increase. So that's 26 bucks a month per unit. We keep doing that year after year, it's going to kill us. And looking at those deductibles, I think we're going to be forced into a position where we have to accept those larger deductibles just to, keep our head above water. I don't think we're going to have any choice but to accept to take on some of that risk ourselves.
Yeah. And at some point with 2.0, once it gets clearer, we may have to tell the general public, our community a little bit more about, we may have to come back and say, this is what is happening in the immediate year or two.
Yeah.
And right away, people will understand, even with changing the deductible, we can put a little slide on the website and say, here's the amount of the premium, here's the deductibles, and here's what the cost is going to be, and a benefit. So maybe it's going to take 40 years to recover. It may be worthwhile to do that one time. It's out there until we see what's really.
Yeah, I think, Dick, your point is super valid. It's like, and again, everybody's at a different age point.
Yeah.
So if we look at there's 1% chance of us experiencing a major flood here. What risk, I'm willing to have to write a check for $5,000 special assessment, to continue to live in paradise and know that I'm going to pay over, $300 more in fees next year, or more than that, 3,000 or 26 bucks a month.
Yeah.
So, yeah. And it's one of those things, you don't want to be out there crying wolf, because
Panic people.
we don't want to panic but everybody around us is on the same boat.
That's it. This conversation you all are having, every board is having it. There's just no great solution right now.
Okay. Lynn, anything else?
Don't get upset.
It won't. You can't offend me. I hope.
Okay, periodically, and I think we've done this maybe 2 years ago or something, you go out for proposals from other agencies. What kind of a situation with agencies? They can't go to the same insurance companies that you provided, I guess, what I'm hearing. So if you go out and get quotes, they can't go back because the insurance agency can't give 2 separate quotes. They have to go to all new insurance companies.
Exactly right. So
Okay.
it's unique to insurance, and it's known as blocking. So whichever insurance agent goes to the marketplace first. When I say marketplace, we're going to the various carriers. Whoever approaches them first essentially has the rights to whatever quote that they may release. So, and I work with new associations all the time too, right? I'm trying to grow my book of business. And this is kind of, I'm gonna say the sell, but this is how I explain this to them. I won't compete for your business, because if you have an incumbent agent who you're happy with, we all share the exact same markets. I can't bring anything to the table that's anything different than what most of your other agents can do. If they're a sizable agent in town, they have the access to every market that we have access to. If you're working with a very small agent, okay, I might have something up my sleeve, but more than likely, probably not. So what I tell folks is, if you're not unhappy with your agent and the service that they're providing, I'm not going to waste your time. What I would tell you is, we market it every single year, not just the property insurance, but all lines of coverage. We give you that marketing summary. And we do the flood insurance, the National Flood Insurance Program is where we are now.
Yeah, your remarks the other day that I shared with the owners, doesn't matter whose name is on the top of it, the premium is the
Premium's
same.
the premium, yeah,
Yeah,
especially.
for flood insurance, but for the other, it could make a small business, but what percentage of the providers do you actually approach when you do this kind of?
So Florida is unique because there's a very small finite number of carriers that are willing to write. So take property insurance, for example. That's the big ticket item.
Right,
There's probably 5 carriers that would realistically write the insurance for these buildings.
and you go to all
We
five.
go to all 5. Yeah.
So to try
So
to
we're-
do something different from.
Everyone shop or
Okay.
fishing out of the
We're
same.
fishing in
Unless
the
you
exact
can, you
same
can
pond.
get a release, if we're absolutely unhappy with you for some
Yeah.
reason, and then we can come to you and you have to give us a release. Okay,
If
so
we,
don't make us unhappy.
well, that's exactly.
Yeah, I understand.
To me, it's a service business and it's unique to insurance and it's especially unique to Florida. It's different than folks that come down from up north because I grew up in New England, right? And you go to an agency down the street from another one, they have totally different carriers. That's just how business is done up there. Florida,
That's why that question came up. I just want to make sure I understood.
So right now, Jeff, on this theme, so let's just take Nash Insurance. They have the policies on this and it's underwritten by Indian Harbor. Is Nash as just I think it's an independent insurance company. I mean, do they really have all the same tools that you're using to go out to everything that's possible?
yeah, I'm biased, but I'll say probably not. I actually don't know Nash. So that tells me they're probably a small agency. Look, we're a very large agency. We work with 800 associations in the area. We've got 150 employees, including we're part of a larger partnership, Acrisure. Together, we make up, I think it's the 8th largest brokerage in the world. The Gulf Shore locally is 150 employees. We've got a huge condo team, and that's essentially our buying power that we use in the marketplace. So when we go to a carrier, we feel very, very comfortable that we have leverage with that carrier to get you as good a renewal as is out there. Yeah, we really do.
Okay.
Just to be one extra step clear here, if we wanted to combine all of our work under one, we'd have to tell Nash before they go out to proposal that we're gonna stop with that, right?
Yeah, that's the way to do it. So remind me, what does Nash insure?
Pump house, guardhouse. Now, someone told me that maybe they started with Nash
These two,
Could have been.
these two.
and Nash doesn't have the capability, Nash doesn't have the capability to cover the whole complex.
Yeah, they probably, as a small agency, they probably don't have access to the carriers that could write it. Yeah, that's a good example of that. Mhm.
So in the long run, it may behoove us to go to somebody that we're already dealing with and for all of it, because you're probably gonna get us a little bit of a discount maybe on the other, but I mean, we're only talking
Yeah.
$3,500 roughly.
So what I would tell you, and this is the conversation I have with every association that I'm trying to do business with, is if you hire me, we're gonna do what's called an agent of record letter. You're basically agreeing, hey Jeff, we're gonna make you the agent. Give you an agent of record letter, you'll sign that. I'll take over the upcoming renewals the other agent had, and then we also remarket it too. We don't just trust that their work is.
Yeah.
is
Well,
good.
no, you gotta.
So,
Okay.
and be straightforward with them, let them know, we're moving coverage, we're gonna need some documentation, thanks for your work, yada, yada, yada. I'll coach you up on kind of how to do those things as well.
Okay.
Again, we don't wanna do that, so we get through 3.
Yeah, we have to.
You understand? You're getting no press from me.
Okay,
Damn words fixed.
So Jeff,
Yeah,
I'll maybe just wrap this up for everybody. Number one, thanks a million for coming in.
of course.
You just
That's
cost
what I
us
do.
how many $1 million? No,
I do feel like the Grim Reaper.
I mean, I think,
now.
the over the last couple years that you've come into like the board meeting in November or whatever, your communications down to the lowest common denominator is great, and I mean, I leave here today going, I think there's everything that we can know as a board about insurance is about where we're at. So thank you for sharing
You're
and,
welcome. That's my goal.
Lynn might be a little lower, but I trust you with our insurance. No, I'm just teasing. So follow-up action. So Jeff, we'd like you to do that worksheet like you did for Woodland. no
That's what-
no $25,000.
That's my address, but that's
They
not
might
who it
not
is.
recognize, I've been shopping, looking at HOA fees, so no $25,000 deductible, just save that column.
Yep.
Um,
And we'll do that in batches, right, as they come up. For example, you know, I think the way James does it is like for February, he'll email them. James works in my office and he sends you the invoices. He'll send you the 3 for February in a spreadsheet. Here's your options. You know, what do you want? And as they come up, we'll do it that way.
yeah, okay.
Sorry.
And then Lynn, we just have to take that master list that Jeff has, bounce that prorate
Yeah.
for each year that we're
Make sure I got the numbers.
confirm that the number's still there.
Is it more helpful for you if I give that to you in an Excel format rather than a PDF? So you can pull stuff out?
Much better, always.
Yeah, so I'll do that.
You could get
We just,
both,
we
but
PDF it because it looks
The
nice.
accountant guy would like to have the Excel, so. I
Yeah,
had to
yeah,
rebuild
no,
an Excel
exactly.
spreadsheet,
No, beautiful.
Which is what I did, by the way.
And then,
I'll save that.
and then for myself, I think I'll take that matrix,
Yeah.
that slide that I made,
Yeah.
turn it into, well, we've got some individual examples.
Yeah.
Well, once we get Jeff's worksheet, that gives us the macro look.
Yeah,
But I'll update those.
and put another line item on the payback on the bottom. I think it makes it easier for people to see if it's $26. You know, if you have a claim, how many years do you take to recover that, you know? So that we can see it, it's very clear that way.
Yeah, that's good. That's where it breaks it out. for
Yeah.
the unit owner, yeah.
that's like it really
Yeah,
is.
okay.
It's nice.
So Jeff, closing comments, otherwise we'll wrap this up.
You know, not that I want to say I'm sorry, because it's not a Gulf Shore or Jeff thing, but this is painful. So don't think as you ask around to other associations, you talk to other board members, they're all going through this. It's just a very painful thing. So just stick with us. My hope is in the next year or two, we'll start to turn this corner, get to a point, and then others will jump into the marketplace to get more competitive. It's typically how these things have gone. And I'm hoping that's the way it's going to go. I would love to come in here every year and give you a 2 or 3% increase, and everybody loves Jeff and we're happy, but we're not at that place.
2 or 3% discount.
Or discount.
So,
Goes with inflation. That's why I say 2 or 3%. So,
Okay,
yeah.
okay, guys. Anything after we hang out, drop, an email out to the whole group, and I think I would just ask everybody, we already got the 3 PowerPoint slides that show deductibles. Start actively I think the only homework assignment really is take a look at that and sort of refine what do you think is that deductible to generate when we go into our next discussion. I almost see us having a special board meeting just to talk about deductibles, and what decision we're going to make to implement to the future, but that's where we're at, so.
I'm very nervous about the community having input in this. Look forward to make the decision. This is a big significant change for people. I think we need to go out to the community a little bit at some of this.
Yeah, I would tell you to
That's another-
discuss with Kim. Kim is great with that. and-
Yeah.
Okay, guys. We're going to terminate this. Thanks a lot.
All right, thanks,
All right,
guys.
thank you.
Okay, thank you.
Thanks a lot, guys.